in the recent years, especially 2023, it was observed a sharp decline of investments happening in tech startups in the Indian context. What we have been terming as funding winter, observed all over the world, in fact, and in India too. Now, this sharp decline, what we are observing, is to the quantum order of up to 90%. It has been observed sector wise if we study, be it gaming industry or crypto industry, edtech industry, the short video app industry, social media. So, all of these, if we see, there's a decline in the investments in these startups. Now, why that is happening, it's important to understand. So, a couple of reasons are there. One, which is more significant, is that most of these startups, which got a lot of funding during the 2021 peak, or what we say during the COVID times, that was largely overestimation or overvaluation of these startups in terms of creating a bubble with these investments coming up and supporting these cash burning model of these startups. So once the COVID has gone, now the other players in the industry have started delivering, and especially in the edtech sector, if we see online media has been dominant during the COVID times, but now physical interaction has resumed. So that way, even other sectors also, from other similar context also, some overvaluation being observed in other sectors, and then post-COVID, it's been realized that that model is not workable, and that was a bubble in fact, and therefore the valuation is also being questioned, and in fact further investments are not happening, and those sectors, those industries, those startups are not generating profit economics. So that is one definitely one reason why this sharp downfall in investments in these sectors, startups. The other one is we have observed in the gaming sector and others, or in the cryptocurrency sector, where we see the issues of regulatory uncertainties, and that is also a driver wherein the investments are falling. So this is definitely there, and more worrisome is the overvaluation of these startups, and in future it is to be seen how these will sustain, because the cash burn models, and if there's no profit economics and everything, then firings happen and people lose their job and the valuation comes down, and the industry or that startup environment doesn't grow, that startup ecosystem doesn't grow, and funding winter remains. So 2023 is over with that funding winter period. Now the investors are largely looking into sustainability and profit economics and product market fit, and real re-evaluation of these startups. We have seen the case of Swiggy being re-evaluated, then Byju's definitely, and many other startups. Oyo is an example. So that is happening. So product market fit is very important from the investor's perspective, and secondly, it is the profit economics. Unit of economics. So the product has to be operationally making money, and not the cash burning model anymore is being supported to recalibrate the valuation of these startups. So with that in mind, if we move forward, then it will be more sustained and more profitable startups, which will be providing a more healthy environment, and even the investors putting more money in such startups. Thank you.